With lower and more attractive tax incentives in the United States, many corporations have been bringing back offshore profits to be recognized and to convert into cash on their balance sheet. Many American corporations now have an influx of cash on their balance sheet, and more specifically have been using a lot of that cash for share buybacks. Today's video, we're going to be discussing share buybacks, the good and the bad, as well as what's going on with the market. Now, every company that's publicly traded has a limited amount of shares it has on the stock market, and those amount of shares can go up and go down. When a company buys back its shares, it first has to announce that it's doing so and get approval for disclosure purposes, and then it has to go and buy them out in the open market. A certain level of share buyback for a corporation is considered healthy, and it's one characteristic that many money managers look for when buying a company. Why? Well, when a company decreases the amount of shares it has outstanding via share buyback, the value of the shares that are remaining become more valuable. Because when it does buy back its shares, those shares go into reserve or get retired, are therefore out of circulation. Given the basic laws of supply and demand in economics, with supply decreasing, all things equal, the demand has a stronger force on the stock and can bring the price up. Let's look at the valuation perspective with a simple example. Company A has 100 million shares outstanding worth $10 each, and they make $100 million in profit. So in other words, this company has an earnings per share or EPS of $1. This is how much earnings is associated with each share that the company has, and therefore the price to earnings ratio is 10. We have a more in-depth video on the price to earnings ratio just up here if you want to take a look. Now let's take a big hypothetical and say the company buys back half its shares outstanding, meaning it buys back 50 million shares and 50 million shares remaining. What happens to the company now? Well, when looking at the value of the shares, the company still has $100 million in profit, but now they have 50 million shares, and therefore the earnings per share are worth $2. The PE ratio subsequently is 5. From a valuation perspective, this company has just become twice as attractive. Its earnings per share has gone up twice as much, and its price to earnings ratio, which we like to be low, has been cut in half. From a non-quantitative perspective, management tends to exert confidence into the market when it buys back its shares. It's sending a message to the world that they believe their stock is a good investment. After all, if they're using their money to buy back the shares and hold them, then it creates a more soothing sentiment to shareholders all across the world that their shares are safe as well. Share buyback can also be a bad thing, especially when companies rely too heavily on it for growth. In other words, you can manipulate a lot of data by heavily buying back your shares. For example, the company can easily say earnings per share has gone up 100% because of share buybacks, but in reality, the fundamentals of the business model has not grown and has not changed. They're still making $100 million in profit. Yes, the shares are more valuable, but the money that can also be used elsewhere. And in the earlier case, the company has shored up a lot of cash, $10 a share times 50 million shares, to buy back their shares. That's $500 million that's being taken away from their balance sheet, or in some cases, going into debt in order to complete the transaction. So are share buybacks good or bad? Well, it depends. Typically, in the broad general characteristic of companies, share buybacks tend to happen for bigger companies. These are large and mid-cap, market cap companies, or the blue chips. When you get to a certain level of size, sometimes the growth opportunities available to you are limited. At the same time, your business model starts to stabilize. An easy way for your company to become more attractive is just to buy back your shares. It's a low-risk method, and considering it doesn't happen to too much of an extended degree, it is considered attractive. In today's market, we look at the S&P 500, and as I said, corporations have a lot of cash on their balance sheet, and we are seeing an influx of share buybacks. Share buybacks in today's market, you can see from the graph, looking at almost a near 2-decade time frame, they are exceeding historical highs. Is this problematic? Some would say yes. When we look at buybacks and dividends as a percentage of the operating earnings in the S&P 500, it's increasingly becoming a larger portion of the earnings. Some would see this as problematic in saying that companies are relying too heavily on share buybacks to boost their earnings and less on organic growth that's actually associated with the economy. And we can see that in this graph right here, with the green line being operating earnings and the red line being share buybacks. In other words, about 54% of all the operating earnings from the S&P 500 as a whole is due to share buybacks. Of course, this data is subject to interpretation. Nevertheless, share buybacks is increasingly becoming a more important part of earnings in 2018, and I predict will be more or less the case in 2019. I don't think it's a cause for panic. It's something you as a shareholder should be aware of. When you look at your holdings, keep an eye on the share buyback programs they announce, as well as the earnings growth associated with share buybacks. We hope this video has been informative. We want to thank you for listening, and once again, happy investing.